So in this lecture, we are going to focus on what are the different types of money market and capital market instruments. So first, let us start with money market instruments. Now, as we defined that money market includes any security which is having a maturity of a year or less than a year. So basically, money market instruments will include all those instruments which are issued for a period which is less than a year. So basically, money market instruments are short-term investment avenues. Now, what are the different types of money market instruments? So it will include treasury bills, then certificate of deposits, commercial paper, repurchase agreement, euro dollars, etc. So these are various ways in which the funds can be collected for short period of time. But there are certain rules and regulations attached to that. So let us understand what are the rules in connection with each of them. So money market instrument first is a treasury bill, or which is popularly known as T-bills. Now, as far as treasury bills are concerned, these are issued when the government is in need of money for a short period of time. Now, treasury bills are presently issued in three different maturities. One is 91 days, secondly 182 days, and 364 days. So you can say roughly from 3 months, 6 months to 12 months, the period is varying for T-bills. Now, T-bills are also known as zero coupon securities, and which is obviously zero coupon, indicating that there is no interest which will be paid on these instruments. So basically, what is zero coupon securities? Coupon means nothing but interest, and zero coupon securities means where there is no interest which will be paid. So you'll be wondering that why a person will invest when there is no interest which is offered by the issuer. Now here, what issuer will do is issuer will issue the instrument at a discounted price or at a reduced price, and at the time of redemption or at the time of cancellation, he will give you back the face value. For example, he will issue the instrument maybe at maybe 95 rupees, and at the time of redemption, he will pay the face value, that is 100 rupees. So here what happens is, even though the investor is not paid any interest, indirectly he is earning out of this investment because he is getting a benefit of 5 rupees against the investment of 95. So indirectly this will be considered as interest earned by the investor. But separately, interest is not being declared by the issuer, and that is why it is called as treasury bills, which is like a zero coupon security. Now, treasury bills are usually held by the financial institutions, including banks. Now, this is basically hold because, again, for banks and financial institutions, they are issuing the fixed deposit or time deposit for a period, 3 months, 6 months, 12 months. So they have to parking their funds for a certain period of time. Like, suppose for a banker, if certain customers come to them or approach them and they're asking to repay their investment, maybe 3 months or 6 months, then they cannot cancel out their loan given and repay the amount to these people. And that's why what the bankers will do is certain percentage of the amount collected will be invested in T-bills. Next is certificate of deposits. Now, as far as certificate of deposits are concerned, these are issued by commercial banks and are insured by the Federal Deposit Insurance Corporation. Like we have seen in last session, that commercial banks is one of the type of bank which has been controlled by the authorities of India. That is, it will be controlled by the RBI. So obviously, these banks are going to issue certificate of deposits, and it is kind of saving certificate with a fixed maturity date and specified fixed interest rate. So unlike T-bills or treasury bills, we have seen that there is no interest which will be paid, but here certificate of deposits, there is a specific fixed interest rate which is offered. Now these are issued in any denomination arising from minimum investment requirements. So according to the requirement of bankers, they will decide to what extent CDs, that is certificate of deposits, can be issued. A, com- a certificate of deposit restrict access to the funds until the maturity date of the investment. So one of the limitation of certificate of deposit is there is no maturity possible before the due date. So it's like a lock-in period. So once you invest, then your investment gets blocked, and at the time of maturity, you will get the returns. In specific cases, you can consider it when it is negotiable. So when it is negotiable, obviously you can sell off and you can deal with, or you can transfer this to someone else and get money out of that. So that becomes easy for you, that if it is negotiable, then you can get the benefit of negotiable instrument. Like it can be uh, 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 issued and transferred to any other person, and sometimes it is non-negotiable. So sometimes there is no uh, uh, there is a restriction on transfer of the securities. Then next you have is commercial papers. Now commercial paper is an unsecured money market instrument which is issued in the form of a promissory note. Now it was introduced in India way back in 1990s, and it can be traded over the OTC market. Now OTC market will study in depth in this session only, but I'll just give you a brief about. In case of OTC market, you have to invest or redeem on the counter. On the counter or over the counter means more of physical, uh, 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 you can say transaction will take place, that you have to go to uh, the issuer and then purchase the instrument or then sell the instrument. So it is happening over the counters. The following entities can issue the commercial papers, that will include corporates, primary dealers, then all India financial institutions. So these are the entities which have got rights for issuing the commercial paper. Now, usually commercial paper is issued at a discount to face value, as may be determined by the user, and is freely transferable. That means you can easily transfer this instrument to any other person, and its maturity ranges a good amount of flexibility is there, right from 7 days to 1 year. So in case of very short term, you can say availability of funds, also you can take the advantage of money market instrument, that is commercial paper, that you can park in your funds even for 7 days. कि usually अगर मुझे विद इन अ फोर्टनाइट पेमेंट करना है, या फिर 7 दिन में या 10 दिन में या 15 दिन में पेमेंट करना है, मेरा पैसा ऐसे ही वेस्ट रह जाता है. But if I have the opportunity of investing in commercial papers, I can get at least some return on the investment. So that is why it is beneficial for few businessmen. Then commercial paper can be issued in denomination of rupees 5 lakh or multiples thereof. So that is a kind of bit restriction for the commercial papers, because if we talk about commercial paper, then it has to be in denomination of 5 lakhs. So it's not cup of tea of every investor that they can invest rupees 5 lakh in a specific company. Next is you have repurchase agreements. Now, as far as repurchase agreements are concerned, these are short-term agreements wherein the seller sells the government security to the buyer and agrees to buy government security back on a later date at a higher price. So naturally, it just happens that they are meeting their short-term requirement of funds. So like I'm already holding certain securities with me, I'm holding certain investment with me, but due to requirement, what I'm doing is I'm selling those government securities to buyer. So why government security? Because it is considered to be risk free, and that's why you are issuing the government security to buyer. For selling the security, you will definitely get the money for that. So that is an advantage for you. And you are agreeing to purchase government security back on a later date at a higher price. So eventually, after a few days, what you will do is you will purchase it back at a higher price. So there should not be any losses to the investor. Rather, investor should make at least certain percentage of profit. So I will sell at a lower rate. Sorry, I will sell at a higher. mm, Means I will sell the instrument at a lower rate. So for him, it is purchase. So for buyer, from investor's perspective, he is purchasing at lower rate, and eventually he's selling back to me. That means I'm purchasing at a higher rate. So obviously he is purchasing at lower rate and selling at a higher rate. So obviously it's a gain for him. Then you have federal funds. Now, this is peculiar in United States, where federal funds are overnight borrowings between the banks and other entities in order to maintain their bank reserves at a Federal Reserve. Now, in case of India also, just to connect with this transaction, that we have got certain requirement like cash reserve ratio, then certain reserves are required to be maintained, that statutory liquidity ratio. So these ratios are required to be maintained, and this indicates that you have to maintain certain securities with you. And once you're maintaining those securities with you, obviously, to that extent your funds will get blocked. So this Federal Reserve, so banks, what they do is they keep reserves at a Federal Reserve Bank to meet their reserve requirement and to clear the financial transactions. So they will keep the funds with them and they will get the benefit of liquidity. Lastly, euro dollars. Now, as far as dollar is concerned, now dollar is globally recognized traded currency, and which is still one of the popular currencies which has been dealt globally. So dollar is denominated deposit. So dollar denominated deposits are held in banks outside the United States. So that will be termed as euro dollars. Basically, euro dollars will be implemented in uh, European market or European countries, wherein the uh, dollar denominated deposits at foreign banks or at overseas branches of American banks are available. So, though not in US, but at other countries, you can uh, think about purchasing euro dollars. So, since they hold outside United States, euro dollar are not subject to a regulation by the Federal Reserve Board, including reserve requirement. Now, reserve requirement are there only for the banks and financial institutions or parties who are investing in United States, but it is very clear that euro dollars are issued outside US. So the Federal Reserve cannot ask for any specific reserve requirement with them. Okay, after learning money market and what are different money market instruments, let us move on to next phase, next part, that is capital market instruments. Now, once we talk about capital market instruments, it means basically capital market is a long-term investment. So when you are investing your amount in capital market, so you are mentally prepared that your funds will be blocked for a longer period of time. And since you're blocking your funds for a longer period of time, the returns will eventually be available, and mostly the return should be on a higher side. So that is the advantage of investing in capital market instruments. Now, what are different capital market instruments? Basically, stocks, then preference shares, common stock, which is popularly known as equity shares. Now, we have studied what is preference and equity shares. Now, preference shares are the both are the owners of the company, but as far as voting rights are concerned, those voting rights are there only with the equity shareholders. So, even though preference shareholder is an owner, but he is entitled to a fixed rate of dividend. So, every year he should be entitled to get a specific amount of dividend. So that is preference shares. Secondly, they are, as the name suggests, preference. So preference stocks or preference shares are given preference while giving dividend or while making the payment or after the redemption, uh, after paying all the legal obligations, taxes, then the priority is given to preference shareholders, and then the last priority will be given to equity shareholders. Now, as far as common stock or equity shares are concerned, they pay variable dividend because they are paying dividend according to the profitability. See, always remember when the company will declare dividend, only when they are having profits. अगर उनके पास profits ही नहीं है, तो do you think the company can declare a dividend? No. So this is an indication that once you are investing in equity market, you will be expecting one, the dividend, and secondly, the price appreciation. Obviously, in short period of time, also we can experience the price fluctuations. But in case of fluctuations in longer period of time, it happens that the market value of equity shares would change, and therefore we should be concerned about uh, the the price fluctuations of equity stock also. So equity shareholders will get basically dividend, and secondly the price appreciation. So these are the two benefits which are available for the equity shareholders. But again, it depends whether you are a short-term investor or whether you are a long-term investor. Next is you have mortgages, that is loans to purchase single multiple family residential housing or land or other real structures wherein the land or structures serve as a collateral for loan. So that means what you're doing is you are keeping your land or residential housing as mortgage, and you are taking the loan for that. So when the land or structures are used as a collateral for obtaining loan, then it becomes easy for both the parties, that is the money lender and money taker, that is the person who is borrowing the amount. So both of them, it is easy because usually the price of land and building will always appreciate. Secondly, whatever the loan is sanctioned, that will be certain percentile of the property value. So once that loan is sanctioned, that will be available for a longer period of time. And definitely when that period of time is fixed, even the rate of interest would be freezed. Nowadays, there is also a concept of charging interest, which is variable. So that indicates that when ever that rate of interest will be changed, like base interest rate जब भी change होगा, जैसे repo rate and reverse repo rate, जब ये rates change होगा, तो तभी आपका capital market accordingly the rate will change, and this change in the rate will be useful for you because this change in the rate is depending on the market circumstances. That means according to the changes in repo and reverse repo rate, the interest rate for the loan will be determined. Next is a corporate bond. Now, usually the corporate bond is issued for a longer period of time and it is issued by the corporate. So companies mainly involved in issuing corporate bonds. Now, usually they have excellent credit ratings which has been given by the credit rating agencies. So these agencies will rate a particular issue, and once a company is coming up with a bond or a debenture, the credit rating agency will give them a specific rating, and according to the credibility, the investors would decide whether it is good to invest in a specific scheme or not, because it has been certified by the credit rating agency. Now, if we talk about the period of maturity, so it ranges from 2 years to 30 years, and obviously for that period of time, you have taken an obligation that you will be paying interest to these entities and or the investors, and at the end of the maturity period, you are obliged to pay them the principal portion. Now, this is peculiarly considered to be less liquid because it cannot be easily traded on the stock market. Now, countries like India, where the bonds and debentures are not so much is not so popular as compared to equity market, so the trading as far as bonds or debentures are concerned is comparatively less. And since its trading is less, obviously the corporate bonds are less liquid as compared to other capital market instruments. Now, after considering what is money market, what is capital market, let us understand what is the role of market makers. Now, as we have discussed the point that the market makers are the parties who are uh, acting as a link between the buyers and sellers of the financial instrument. So, in short, it is a link between the person who is having excess money and the person who is in need of money for carrying out his business. So, to bridge this gap, there is an intermediary called money market makers. So, what they do is, sorry, not money market makers, market makers. So, uh, in general, market makers will help you to help the companies to find their investors and help investors to find the the companies where or the companies or the parties where they can invest. So that's a good link which is established by these market makers. Secondly, as a layman, you cannot study everything, but since market makers are into those operations, so they can easily guide you about which is a good proposal, where you should invest and where you should not. So accordingly, you can take the decision taking the help of these market makers. Next is it helps to maintain a smoothly functioning and orderly uh, execution of the financial transactions in the stock markets or in the financial market. Lastly, it receives, processes, interpret, and disseminate information to potential buyers and sellers. Like when the company is planning to go for expansion or diversification or issuing dividend or taking some major decision about growth or anything relating to company, then it is essential that this information should be made available to the investors. So according to the investors' knowledge, they will choose to invest or not to invest in a specific instrument. So that is a good way of understanding that when and how much you can invest. And for that purpose, proper and timely information is required, and which is provided by the market makers. So, in simple words, what they do is they assist in raising the funds to finance deficits by marketing a borrower's new securities in the primary market. So, you have seen that in case of primary market, what happens? Here, the instruments are traded for the first time. Not traded, instruments are issued for the first time. So, like in case of bonds or debentures, when we say that the bonds or debentures or equity share capital is issued first time in the market, so then it is considered that it is issued in primary market. But once that instrument is issued in the primary market, then the information is passed on to the prospective investors or buyers or the other parties, wherein you can take the decision about the investments. Likewise, they can help you out that once that investor has lost an opportunity of investing in the primary market, he also opens the door to the next level, that is the secondary market. So if an investor has not able to subscribe shares or securities in first stroke in the in the market, then eventually you will be able to find out a way for them to invest in the stock market, and that way is nothing but taking the help of stock markets, where the company shares are listed, then it is open for public to purchase and sell the shares of the company, and thereby making uh, profit. So you can say additional benefits to the investor, so that investors can get profit in the primary as well as secondary market. And corporates, anyways, they have already received amount in the primary market issue. So obviously they will not be concerned with subsequent purchase sale transactions. Okay. Then we have to understand who are different market makers. Now, first one is a broker. Now, broker obviously is a person who is an agent on behalf of the client. So he acts as an agent for or on behalf of the client, and then he assists in purchasing and selling the securities and can give access to market. Now, if you have already enrolled or uh, any of the brokers, so that broker will give you an advantage that the broker will allow you to purchase and sell securities, and he will also give you a limit. Now that limit indicates to what extent you can invest. So that limit will be considered by the investor, and he can purchase and sell the securities and thereby make the profit. Next entity है broker dealer. Now who is a broker dealer? It can also trade for their own account. Now usually when we talk about brokers, they trade uh, not on behalf of the client, but they trade on their own behalf. But as far as broker dealer is concerned, he can also trade for their own account and maybe a market maker. So he can have his own account wherein he is trading, plus he can have his customers, or you can say client base, through which he's making another quantum of money, and that may result in the profits for the broker dealer as well as for the investor who has invested the money. Next is inter-dealer broker. Now, what is the meaning of inter-dealer broker? Now, he is a person who facilitates trades between the broker dealers and other financial institutions rather than individuals. Now, when we talk about dealing with a broker and a broker dealer, so it is not easy always that you can trade and you can have a transaction between the parties, and that's why what you can consider is you can help the uh, broker dealers to deal with another broker dealer. So it's an intermediary between two intermediaries, so that role becomes a bit critical for him, that he is a inter-dealer broker. So these are all market makers who help you, me, and all the other people to invest the amount in the stock market or in any financial market instruments. Okay, then why market makers make markets? So what is their main purpose? Obviously, first is expected profits. So mainly from the revenue generated by price it charges for conducting a transaction. That is nothing but the brokerage. Secondly, the number of transaction engaged in. So considering the volume of the transaction, the broker may allow you certain benefits or may withdraw certain benefits. So considering the quantum of transaction, you may be provided with an additional benefit. Then capital gains or losses associated with the inventory of the securities. So there is expected price appreciation. So short term you can make a profit, and again what you do is, again when the price is coming down, then you can again purchase the stock and you can hold it for a good period of time. Then obviously why they charge fees? They charge fees for the brokerage or the commission which is charged by them for each of the transactions. Now, if you see your every contract note, that contract note will mention through whom or who is your broker, your name, and other details. And also it will specify how much is the transaction uh, carried out through the specific uh, person. So for each of the transaction, the brokerage as well as securities transaction tax is imposed. So after paying both of them, then what remains will be considered as your net income. So it is a function of a spread between the bid and the ask price and the number of transactions. So for in case of futures contract, it happens that there is a price fluctuation and different prices are available. So at that particular point of time, what you do is you can take the difference between the purchase and the selling price. So spread, मतलब movement stock का या price का कितना है, वो spread देख के आप decision ले सकते हो. So if you feel that you cannot stretch the transaction for more than 2 months because there is a good amount of price fluctuation, then you can rethink that whether you want to enter this kind of risky transaction, or you can restrict yourself for the spot market transaction, or you can go for capital market transaction, but just do the transaction and uh, see if you can make profit out of it. And if you do not make profit, that is fine, because there are always ups and downs in the market. There are many brokers who make profit, who lose profit. So all these things are going on and on. Then the next part is exchange traded and OTC market. Now this part we have covered in between, that is in initial slides, that how uh, OTC transaction takes place. Here, there is a trade between two parties on a private basis. So, just I was explaining you the difference between the futures and the forward contract. So, in case of future contract, there is a third party involved, and therefore you can say my transaction is safe and sound. But as far as OTC transactions are concerned, here the transaction will be taken place between private parties, and the custom products, and selected products only will be available for dealing there, because if the transaction is routed through stock market, then you cannot complete the transaction as per your terms and conditions. You have to follow your rules, and you have to follow the rules and regulation of the stock market, and therefore we will consider only selected products will be made available in case of OTC market. Then you have exchange traded, wherein physical or virtual. Like initially, if we talk about the initial phase where the stock market was taking boom, at that time, everything was in a physical form. Slowly, gradually, they made it virtual, and thereby you started making transactions through your laptops or computers. Now, if you see this further progress, you can deal on your mobiles, or you can deal on your uh, iPad, or you can deal on your different gadgets, and you can easily carry out the transaction. Only thing is you should be registered with a broker through whom you can carry out the transaction. Obviously, when it comes to exchange traded, it has to be regulated, because there has to be a specific timeline provisions or timeline process which you have to apply. And here, that regulation will be maintained strictly. Transaction costs tend to be low. Here transaction costs will be very low, because it's only the brokerage and the STD. Rest of the charges are not being levied here. So next is okay, after considering the points in connection with how capital and money market are implemented, and how the transaction takes place in OTC and exchange trading based contract, or you can say through stock markets. So let us move to next part, at how the various financial services are provided with. First is a depository. Now, if you have gone through NSD or CDSL website, you will get surprised to see n number of transactions there. Now, this n number of transaction, what does this mean? It doesn't mean anything. It actually means you can carry out various kind of transaction, that may be your futures and forward contract with respect to a mutual fund, derivatives, normal spot market transaction, that is shares, securities, bonds, debentures. At the same time, it is also available for the taxation and other angle, which is also been monitored by NSDL. So you can pay advanced taxes, you can pay uh, the other taxes, and yeah, with the help of these sites. So they act as an again intermediary between the parties who are liable for paying, and the parties who are supposed to receive the taxes. So it's a link between both of them. Next is a custodian. Now, custodian is a person who is a financial institution that holds customers' securities for safekeeping in order to minimize the risk of their theft and loss. So it is bound to happen that sometimes when you're holding the security for quite a long period of time, then you may end up losing that instrument, or you may end up not being aware about specific transaction. So as far as custodians are concerned, they help you out to maintain all the records and guarantee that your certificates will not get lost. So that is how the custodians do operate. Next is a credit rating agency. As far as credit rating agency is concerned, there are popular credit rating agencies like CRISIL, ICRA, which helps to assign a specific credit rating according to the issuer's ability, or you can say debtor's ability, to pay back the debt in future period of time, not only the interest portion but also the principal portion, because the credit rating agencies are giving rating for each of the new instrument. So for example, if a company is issuing new debentures, then the role of credit rating agency would be to evaluate whether that instrument is having lower risk, and secondly, every instrument definitely will have certain percentage of risk. So their role will be to calculate how much risk a person is taking by investing in a specific instrument. So ये जो क्रेडिट रेटिंग एजेंसीज है वो किसी स्पेसिफिक इशू के लिए सॉरी किसी स्पेसिफिक कंपनी के लिए बात नहीं करेंगे. सो दे विल पे फॉर sorry, they will give rating for a specific issue and not for a specific company. So that means suppose Reliance is coming up with the issue of debentures, so they are not going to rate the Reliance. They are going to rate the issue of debentures which is made by Reliance. So it's a specific rating which has been provided by the credit rating agencies. Now, here they not only consider financial factors, but they also consider other factors like what is the goal of the company or what is the vision and mission of the company, because that is what will take the company forward in future. So if the company doesn't have a vision or mission as to how the company will cope up with the new challenges in the market, so then obviously the issue would not be successful, because then there is a risk that the company will go in bankruptcy. So the credit rating agencies has to be very uh, peculiar about evaluating the issue. Secondly, they will deal with their audit report, director's report. They will talk with the outside parties. They will check their tax and other legal compliances. And in case of any ISO or any other certifications, so whether these certifications has been obtained properly and which has been practically maintained by the company. Secondly, they will check any adversities in the auditor's report. They will also check what the director is looking forward in case of business. Lastly, they will also consider how different stakeholders of the company are at benefit. So whether it is a creditor, debtor, bankers, the financial institutions, employees, management team, and the customer. So all these aspects will be taken into consideration together, and the rating would be given. Now, every company will give rating according to their norms and standards. So, if we consider a rating for a specific issue may be different from two different agencies' perspective, but again, we have to go back to their original set of standards. We have to compare what are their standards and accordingly check whether that rating is suitable as per your requirement. So that rating may be BB, triple B, A plus. So these are the various ways in which, or mm, uh, the, the ways in which uh, the issue has been expressed. So the credit rating agencies will the in help the companies to decide at which rate the security should be issued. So, for example, the debentures are issued by the Reliance. So, after considering their background, they will decide at which rate of interest the credit rating agency, sorry, at which rate of interest the company should issue a debenture. Next is a factoring. Now, factoring is a person who helps the company to recover the amount. Now, why factor is important? Because it is like a debt recovery agent. He works like a debt recovery agent, wherein he is concerned with whether you are recovering the money or not. And for that purpose, he is considering that how much time or how much credit period is given to the customers, and accordingly, the factor will keep paying the company certain percentage of amount. So usually the factors pay around 70 to 80% of the bill amount immediately. And once that balance amount is recovered by them, then they will deduct their commission and balance amount is given back to you. So that is the role of a factor. So factor works like a debt recovery agent. So he recovers the amount from the customers and give it back to the companies. Next is forfeiting. Now, forfeiting is nothing but a financing that enables exporters to receive the immediate cash by selling their medium and long-term receivables. So it is similar to bills receivable, wherein the bills receivable is discounted with the bankers and you get the amount after discounting. So likewise, in case of forfeiting, when you are exporting something and going to receive the amount in cash. So what they do is they sell their medium and long term receivables and the amount which an importer owes the exporter at a discount through an intermediary. So they get that amount in advance, and obviously at maturity date, the forfeiting agency will collect the amount from the customer, and uh, after deducting commission, whatever is balance amount which is due to the company, that would be paid back. So obviously they work again like a debt recovery agent, but it is in case of international transaction. Then you have merchant banking or merchant bank, wherein a company that is conducting underwriting or loan services, financial advising, fundraising services for large corporations and high net worth individuals. So merchant banker is a quite wide term which will include various activities. Now, underwriting means when a company is issuing shares, there is a restriction that up to 90% of their shares should be subscribed by the people or investors. So let us see, if a company is issuing 1 crore shares, at least 90% shares, that means 90 lakh worth of 90 lakh number of shares has to be subscribed by the public. And if it is not being subscribed by the public, then it is then the issue is considered to be a failed issue, and then the amount has to be given back to the person, that the investor. So that's why this merchant bank acts as an underwriter. Now, what is the underwriting service? Here, what you do is you are uh, guaranteeing payment of the future. Basically, underwriting means you are guaranteeing payment in case of damage or financial loss, and you accept the entire financial risk for liability arising from such guarantee. So that means here, what is the risk? Here, the risk is if the issue is not successful, then entire amount will be repaid back to the shareholders or investors. So to avoid this risk, what merchant bankers will do is the what the merchant bankers will do is they will act as an underwriter, wherein they will guarantee that in case the issue is not successful, we guarantee to purchase certain number of shares. So that helps the company to uh, uh, be rest assured about the successful issue. And the underwriting agencies like a merchant bank, they definitely get the commission for carrying out this activity. Now, it's not just merchant banking do underwriting services, there are other entities also, but merchant bank is one of the main players who provide the underwriting services. Obviously, loan and other financial advising and fundraising services also provided by the merchant bankers, but they mainly focus on HNIs, that is high net worth individuals and corporate clients. Then you have a couple of terms like leasing, hire purchase, and portfolio management services. Now, out of which leasing means when uh, the lessor, that is the owner of the asset, gives the utilization rights or usage rights to another party, that is lessee. So here the lessee will be using that asset for a specific period of time, and for which the lessor is charging some amount which is called as a lease rent. So here you are getting advantage that you need not invest the amount of asset. Like suppose the asset is worth rupees 1 crore, then you need not invest 1 crore. You can get that asset on lease basis. Only thing is you'll be end up paying the lease rental to the owner of the asset, or you can say to the lesser person. So leasing gives a benefit of not investing huge amount of funds together, and secondly, you need not take a loan from the bank and purchase the asset, because sometimes you need that asset not for a very long period of time but for a limited period of time. And based on which there are two types of leasing: one is a financial lease and one is an operating lease. Now, as far as operating lease is concerned, this lease will be there for a short period of time, and so here the lease will be there only for a short period of time, like 3 to 4 years, but compared to that, financial lease will considerably uh, cover the useful life of the asset. So let us say if the useful life of the asset is 10 years, then finance lease is usually covering 7 to 8 years, or sometimes even 10 years. So after that period, or after the leasing period, there is a agreement that at the end of the lease period, the asset will be given to the lessee for a nominal value. So that is an added advantage for the lessor, that lessor is getting that asset. Uh, Lessor is giving that asset to the lessee, but it is not direct transfer. And if it is transferred directly, then he has to pay a good amount of money at the initial level. Next is a hire purchase. Now, sometimes you will not be in a position to pay the amount immediately. You will like to receive you will like to make the payment in installments. So when you are doing the payment in installments, so at that particular point of time, the ownership of the asset will be transferred only when the last installment is paid. So for example, you are purchasing a machine and you are paying 1 lakh as down payment, and you have agreed 50,000 to be paid for next 6 months. So once that 50,000 is paid each month for a period of next 6 months, so that is 1 plus 3, total 4 lakh. Once it is paid, then you can say the ownership will be transferred to another person, that is lessee. Not lessee, sorry. The ownership will be transferred to the buyer. So that is a transaction which is called hire purchase transaction. Sometimes this period extends more than a year as well. So sometimes you decide the annual payment or annual installments, and accordingly the payment will be made by the buyer. Lastly, portfolio management services. As we discussed about, there are various options of dealing in stock markets. You can deal in spot market, or you can invest through uh, uh, the stock markets, either purchase and sell shares or commodities or currencies. But that you can do in spot market. But at the same time, there's another option available, that you can deal in a forward market also, that is forward and future transactions. But as far as PMS, or you can say portfolio management services, are concerned, it will include not only monitoring your portfolio. Now, portfolio is nothing but uh, a bunch of all the investment. Now, it is usually said that an investor will not keep all the investment in one fund or at one place. So, what the investor will do is he will bifurcate his investment into different categories. So according to categories of investment, maybe certain investments are risky, some investments are secured but giving lower returns, and some are giving moderate returns but with a moderate risk. So whatever are the components of your portfolio with a specific target, you have to check whether those targets are achieved. And if those targets are not achieved, you have to make modification in your portfolio. So this entire management services are being provided by certain brokers or financial intermediaries or financial advisors who help you to take decision about how to structure a portfolio and how to maintain that portfolio. Now, sometimes they give you an option that you pay them the amount and they will trade on your behalf. And sometimes they ask you uh, like suppose, for example, they will tell you that, okay, you give me 5 lakh rupees and I will give you a rate of return of 12%. So it is their lookout, they are making 10%, 5% or 40%. Till the time they are guaranteeing you a payment of 12%. So there is no problem which has been seen in this specific transaction. So what you have to consider in this case is the portfolio management services will include either like this, where the payment is made and they will give you fixed returns, and secondly, there is second type wherein the control will be there in your hands. They will advise you as to how to structure a portfolio and how to design the investment into various instruments. And accordingly, that management services will be provided by them, and they will also guide you for different types of investment opportunities or plans wherein you can make additional profits. So that is portfolio management services. So these are different financial services which has been available in the financial markets. So obviously In each of these area, there is a very good scope for having a career in finance, being a part of the finance student. So this is a peculiar area we have to study in the financial services and financial markets.